Imagine your business partner shows up daily, wildly swinging between euphoria and despair. One day he's desperate to sell you his share for pennies. The next, he's buying yours back for far too much. This isn't madness you ignore. It's a golden opportunity. Fail to understand Mr. Market's irrationality, and you'll always be at his mercy. Grasp it, and his moods become your greatest asset. 1. Investor or speculator. Welcome, high-performance minds, to Audiobook Bites. Today, we're cracking open Benjamin Graham's timeless classic, The Intelligent Investor, specifically diving into the fundamental question. Are you truly an investor or merely a speculator? Graham doesn't mince words. He draws a hard, clear line, one that many on Wall Street would prefer you didn't see. His definition is precise, an anchor in turbulent waters. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Think of it this way. A true investor is like a shrewd business owner, meticulously evaluating a company, understanding its inherent value, and demanding protection for their capital. They seek a reasonable, adequate return, not a lottery win. Here's the catch. Most people mistakenly believe they're investing when they're actually speculating. Wall Street, with its flashy jargon and endless stream of hot tips, often blurs this vital distinction. It encourages individuals to chase price movements, to gamble on what others might pay, rather than focusing on the underlying business. Imagine waking up tomorrow to a market that has soared based purely on a rumor, then dropping sharply just as fast. The speculator would be caught in the storm, hoping for a quick exit. The investor, having done their homework, would likely view it as a temporary blip or even a buying opportunity. But the problem is, this confusion is dangerous. When you don't grasp this core difference, you invite unnecessary risk into your financial life. You might be thinking, but I want big returns. Isn't that risky? Graham would respond, a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business, with an underlying value that does not depend on its share price. Therefore, true investment focuses on that solid business value, not on fleeting popularity. The market, Graham reminds us, is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. This isn't about predicting the pendulum's swing. It's about understanding its nature. But if you're swept up in the emotion, you become another cog in the speculative machine. No matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. This wisdom shifts your focus from anticipating the unpredictable to protecting yourself from the inevitable. So, how do you define your path? If you commit to thorough analysis, prioritize safety of principle, and aim for adequate, disciplined returns, Graham promises you a robust financial future. Imagine waking up years from now, having built substantial wealth not from luck or hype, but from consistent, intelligent action. That's the investor's journey. The bottom line, the sillier the market's behavior, the greater the opportunity for the business-like investor. Follow Graham and you will profit from folly rather than participate in it. If you're ready to cultivate the emotional discipline and intellectual framework to profit from folly, subscribe to Audiobook Bites. Don't miss out on transforming your financial decisions from guesswork to wisdom. 3. Portfolio for the defensive investor. The defensive investor has a clear mission. Achieve satisfactory results with minimal effort and maximum safety. They aren't chasing the hottest tips or trying to outsmart Wall Street's daily gyrations. Instead, their power lies in a disciplined, almost serene approach. Graham prescribes a core portfolio of high-grade bonds and a diversified list of leading common stocks. Think of it like a sturdy ship built for calm waters and occasional storms, rather than a speedboat designed for reckless races. The allocation isn't rigid, but he suggests maintaining a balance, say, 50% in bonds and 50% in stocks. You might be thinking, What about when the market shifts? Here's the magic: rebalancing. If your stock soar and now represents 60% of your portfolio, you sell a portion to bring it back to 50%, moving the proceeds into bonds. Conversely, if stocks dip to 40%, you buy more, bringing it back to your target. This seems counterintuitive to some, but it's precisely this disciplined, unemotional action that allows you to buy low and sell high without trying to predict anything. Therefore, rebalancing acts as your personal market timer, forcing you to profit from extremes. This strategy offers incredible freedom. Imagine waking up tomorrow not needing to check the financial news or agonize over every market tremor. The defensive investor understands that trying to time the market is a fool's errand. As Graham wisely put it, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework. You must supply the emotional discipline. This framework shields you from the madness of crowds. The market, after all, is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes stocks too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. By pre-committing to rebalance, you automatically act like that realist, selling when the pendulum swings to optimism, high prices, and buying when it swings to pessimism, low prices. You're not guessing, you're simply executing a plan. This simple, mechanical act is your shield against the corrosive power of emotion. The bottom line: follow Graham and you will profit from folly rather than participate in it. If you want more insights into building a resilient portfolio and mastering your investment psychology, subscribe to Audiobook Bites so you don't miss our deep dives into timeless financial wisdom. 3. Portfolio for the defensive investor. The defensive investor has a clear mission: achieve satisfactory results with minimal effort and maximum safety. They aren't chasing the hottest tips or trying to outsmart Wall Street's daily gyrations. Instead, their power lies in a disciplined, almost serene approach. Graham prescribes a core portfolio of high-grade bonds and a diversified list of leading common stocks. Think of it like a sturdy ship built for calm waters and occasional storms, rather than a speedboat designed for reckless races. The allocation isn't rigid, but he suggests maintaining a balance, say, 50% in bonds and 50% in stocks. You might be thinking, what about when the market shifts? Here's the magic: rebalancing. If your stocks soar and now represents 60% of your portfolio, you sell a portion to bring it back to 50%, moving the proceeds into bonds. Conversely, if stocks dip to 40%, you buy more, bringing it back to your target. This seems counterintuitive to some, but it's precisely this disciplined, unemotional action that allows you to buy low and sell high without trying to predict anything. Therefore, rebalancing acts as your personal market timer, forcing you to profit from extremes. This strategy offers incredible freedom. Imagine waking up tomorrow not needing to check the financial news or agonize over every market tremor. The defensive investor understands that trying to time the market is a fool's errand. As Graham wisely put it, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework. You must supply the emotional discipline. This framework shields you from the madness of crowds. The market, after all, is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes stocks too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. By pre-committing to rebalance, you automatically act like that realist, selling when the pendulum swings to optimism, high prices, and buying when it swings to pessimism, low prices. You're not guessing, you're simply executing a plan. This simple, mechanical act is your shield against the corrosive power of emotion. The bottom line: follow Graham and you will profit from folly rather than participate in it. If you want more insights into building a resilient portfolio and mastering your investment psychology, subscribe to Audiobook Bites so you don't miss our deep dives into timeless financial wisdom. 4. Portfolio for the enterprising investor. The enterprising investor isn't looking for easy money. They're willing to dedicate serious time and intellectual effort to achieve better than average results. This isn't a passive stroll. It's a deliberate hunt for opportunity, a quasi-business demanding skill and patience. Think of it like a seasoned antique dealer. They don't just buy whatever's flashy and new. They scour forgotten corners, look past superficial flaws, and uncover hidden treasures. For the enterprising investor, these treasures often come in three forms: bargain issues, special situations, and unpopular large companies. First, bargain issues. These are the true net-nets. Companies selling for less than their net current assets alone. Imagine walking into a grocery store where they're selling an entire cart of perfectly good, essential items for less than what the loose change in your pocket is worth. That's the kind of discrepancy we're talking about. Graham insisted, only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. For the active investor, this means digging deep into balance sheets, bypassing market sentiment to find true underlying value. Then there are special situations or workouts. These involve complex corporate maneuvers like mergers, liquidations, or reorganizations. It's like a corporate chess game. The market often undervalues companies caught in these intricate legal processes, creating temporary mispricings. Here's the catch. These aren't simple set-it-and-forget-it plays. They demand intricate analysis, a keen understanding of legal and financial restructuring, and the willingness to take on specific, non-market risks. But for those with the right temperament and expertise, they can offer substantial, predictable returns. Finally, the enterprising investor seeks out unpopular large companies. These are well-established businesses, perhaps a bit boring or out of favor, whose stock prices have been driven down by temporary setbacks or pervasive market pessimism. You might be thinking, why would anyone want a boring stock? But this is where wisdom meets opportunity. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. Wall Street, with its short attention span, often overreacts to bad news, throwing solid companies into the bargain bin. Therefore, the active investor steps in, buys what the crowd shuns, and waits for intrinsic value to reassert itself. This approach isn't about predicting the next hot industry or timing market peaks and troughs. It's about rigorous analysis of individual businesses, focusing on their financial strength, earning stability, and asset value, then acquiring them at a demonstrable discount to their true worth. It's a painstaking process, requiring emotional discipline to act contrary to prevailing sentiment. Picture yourself a decade from now, not wondering if you got lucky with a hot tip, but confident in a portfolio of solid businesses you patiently acquired during times of market folly. Your wealth has grown, not because of speculative gambles, but because you dedicated yourself to understanding value and acting with courage. The bottom line, the enterprising investor profits not from following the crowd, but from the quiet, persistent power of value unearthed through relentless, intelligent effort. 5. Ignoring market noise. The market is a noisy, chaotic place, a digital ocean of flashing numbers and breathless predictions. Every day, it whispers, shouts, or screams, trying to tell you what to do. Buy now, sell everything. The temptation to time these movements is immense. We see a stock soar and wish we'd bought it. We see another plummet and panic, wondering if we should sell. But here's the catch. Attempting to predict these short-term swings is a speculative endeavor, often more akin to gambling than investing. People pour immense energy into forecasting, reading charts, and interpreting gurus, but the market's randomness usually defeats even the sharpest minds. Therefore, relying on timing to build wealth is a fool's errand for most. Benjamin Graham, the father of value investing, gave us a profound metaphor. Imagine you own a small share in a private business, and one of your partners, Mr. Market, is incredibly obliging. Every day, he offers to buy your share or sell you more. Sometimes he's cheerful and quotes a ridiculously high price. Other days, he's depressed and offers to sell for next to nothing. The market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes stocks too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. The speculator hangs on Mr. Market's every mood swing, buying when he's euphoric and selling when he's despairing, often to their detriment. But the true investor, they ignore his moods. They know their business's underlying value doesn't change daily just because Mr. Market feels like it. They treat his wild offers not as commands, but as opportunities. Imagine waking up tomorrow to a major market crash. The speculator sees disaster. The intelligent investor sees a grand sale. You might be thinking, but everyone else is panicking. How can I stay calm? It's hard, yes, but essential. The sillier the market's behavior, the greater the opportunity for the business-like investor. Follow Graham and you will profit from folly rather than participate in it. This isn't about IQ. It's about controlling your innate human tendency to follow the crowd. Ultimately, true investment success isn't about perfectly predicting the unpredictable. It's about having a solid strategy, understanding the inherent value of what you own, and maintaining the fortitude to act against the prevailing winds of emotion. This disciplined approach transforms market fluctuations from a source of anxiety into a wellspring of opportunity. The bottom line, to invest successfully, you must supply the emotional discipline to seize Mr. Market's offers, not succumb to his whims. 6. Protecting against inflation. Inflation, the silent thief, is always lurking. Imagine you've worked hard, saved diligently, and built a nest egg. Now imagine a sneaky pest, a tiny little termite, nibbling away at your savings, day after day, year after year. You don't see it happen, but its damage is real. That, my friends, is inflation, the relentless erosion of your money's purchasing power. For investors, this silent thief is a persistent challenge. For decades, many believed common stocks were the perfect antidote. The thinking went, companies raise prices during inflation, boosting their profits, and stock prices rise along with them. But Graham, ever the realist, warned against this automatic assumption. He saw that while common stocks can offer protection, they are far from an automatic hedge. But here's the catch asterisk: if stocks are already highly valued, their ability to keep pace with soaring prices diminishes. Therefore, simply buying stocks is not an automatic shield against the silent thief. We've seen this countless times in history, when inflation raged and stocks still delivered measly returns. So, if stocks aren't a perfect shield, what about other assets? Fixed income bonds, the traditional safe haven, tend to suffer most. Why? Because the fixed interest payments they provide buy less and less as prices rise. Therefore, relying solely on traditional fixed-rate bonds during inflationary times is like bringing a spoon to a gunfight. What does an intelligent investor do? They don't just hope for the best. They prepare for the unexpected. One powerful tool Graham couldn't have fully foreseen, but anticipated with his vision of index bonds, is Treasury inflation-protected securities, or TIPS. These government bonds are designed to do exactly what their name suggests. Their principal value rises with inflation, preserving your purchasing power. But here's the catch asterisk: this inflation adjustment is considered taxable income, even if you don't sell the bond. Therefore, to avoid paying taxes on money you haven't actually realized, TIPS are best held in tax-deferred retirement accounts like an IRA or 401k. Real estate can also offer some inflation protection, as property values often rise with the cost of living. But real estate also comes with its own set of challenges. It's illiquid, prone to local market fluctuations, and not easily diversified for the average investor. Precious metals, like gold, are often touted as the ultimate inflation hedge. Graham acknowledged them but pointed out their lack of income and storage costs, and historically, their performance has been erratic. The intelligent investor knows that no single asset is a perfect, foolproof hedge. But, therefore, true protection against inflation comes from a well-diversified portfolio that strategically includes assets with different inflation hedging characteristics like TIPS and carefully selected real estate to preserve purchasing power. It requires thinking critically, not just following popular fads. It requires emotional discipline to avoid the temptation of overpriced sure things and to stick to your plan when everyone else is panicking. The bottom line, no matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. 7. Valuation beyond hype. The allure of growth stocks is undeniable. Who wouldn't want to find the next game-changing company, invest early, and ride its meteoric rise to untold riches? This is a vision painted vividly across Wall Street, often accompanied by complex mathematical projections promising exponential earnings years into the future. But Benjamin Graham, the father of value investing, offers a stark warning that cuts through this seductive fantasy. He taught us a fundamental truth. A great company is not a great investment if you pay too much for the stock. Imagine you're at a high-stakes auction for a magnificent racehorse, a proven winner. The crowd is in a frenzy, shouting ever higher prices, fueled by the memory of its last dazzling victory and the promise of future championships. Everyone believes this horse will keep winning, faster and faster, forever, effortlessly outpacing all competitors. You, too, feel the excitement, the urge to join the bidding, to own a piece of that seemingly guaranteed success. Asterisk, here's the catch, asterisk, a truly intelligent bidder wouldn't just focus on the horse's last race or the auctioneer's optimistic predictions. They would scrutinize its pedigree, its veterinary records, its training regimen, its age, and even the track conditions that favored its past wins. Most critically, they would compare the price being demanded against a sober, realistic assessment of its sustainable performance over many seasons, not just the next few races. Paying an exorbitant price for past glory and uncertain future triumphs can quickly turn a dream into a financial nightmare. Graham explains that companies exhibiting unusually rapid growth, those often deemed glamorous by the market, frequently sell at prices that reflect boundless, almost infinite, future expectations. But human nature, combined with the relentless pressures of competition and the inherent limits of expansion, dictates that such rapid growth cannot keep up forever. A small company might double its sales easily, but a giant generating tens of billions in revenue will struggle to find another equivalent market to conquer. Eventually, the growth curve flatters out or worse, turns downward. What then happens to a stock priced for perpetual acceleration? You might be thinking, but aren't some companies truly exceptional, destined for long-term dominance? And yes, some are. Graham wasn't blind to innovation. He understood that companies like IBM in its early days could transform industries. Asterisk, but here's the critical difference, asterisk, the market, in its unsustainable optimism, often bids up the price of these hot issues far beyond any reasonable valuation. When the price of a stock becomes detached from the underlying business's tangible value and sustainable earning power, it crosses a dangerous line into pure speculation. As Graham wisely states, a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business, with an underlying value that does not depend on its share price. The intelligent investor focuses on that fundamental business, not the transient ticker symbol and the emotional hype surrounding it. Relying on projections that are, by their very nature, highly imprecise assumptions, is a recipe for vulnerability. The more dependent a valuation becomes on hypothetical future growth, especially growth rates above, say, 8% annually projected far into the future, the more fragile it becomes. We saw this vividly during the dot-com bubble, when countless companies with little more than hype were valued astronomically, only to crash when their infinite growth proved finite. The actual growth often proved far less than anticipated, and the market ruthlessly punished those who had overpaid. Therefore, the intelligent investor must resist the urge to chase glamorous growth stocks at inflated prices. Instead, seek out companies that are sound, perhaps less fashionable, and most importantly, available at a reasonable price relative to their current sustainable earnings. This approach isn't about avoiding growth. It's about avoiding the growth trap, the peril of overpaying for potential that may never materialize, or materializes less spectacularly than imagined. 8. The power of thorough analysis. When we think of investing, many conjure images of flashing screens, intricate algorithms, and brilliant market timers. But Benjamin Graham, the father of value investing, offered a far more grounded perspective. He famously taught us that a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business, with an underlying value that does not depend on its share price. This profound yet simple truth is the cornerstone of intelligent investing. It means treating every share you buy as if you were purchasing a piece of a farm, a laundromat, or a restaurant, or not merely a number on a screen. To truly understand that business, you must become a diligent detective. And Wall Street, with its endless array of financial acrobatics, often makes this detective work harder than it needs to be. For decades, companies have used accounting gimmicks to paint rosier pictures than reality would allow. Think of pro forma earnings, which exploded in popularity in the late 1990s. Companies would report profits as if certain unusual or non-recurring charges simply didn't exist. Imagine you're running a lemonade stand and you keep losing money because the lemons are spoiled. Your pro forma earnings would show a profit, as if you hadn't bought bad lemons. But it gets worse. These non-recurring charges often recurred, year after year, like a bad penny. Lucent Technologies, a giant in the year 2000, capitalized software development costs that were, by any reasonable standard, routine business expenses. This artificially boosted their assets and made their losses look smaller. Scrutinize any financial statement that consistently separates good profits from bad expenses. But diligent research goes beyond just the numbers. It extends to the people behind them. Intelligent investors must evaluate management's honesty and competence. Are they truly working for your benefit, the shareholder, or for their own? Consider the cautionary tale of Enron. Its executives set up partnerships that bought assets from Enron. Here's the catch. The chief financial officer of Enron was the managing member of these partnerships, directly profiting from sales that ultimately hurt Enron's bottom line. Therefore, understanding the potential conflicts of interest, buried deep in proxy statements, becomes paramount. If managers are rewarded with stock options designed to align their interests with yours, yet they dump millions of shares after exercising them, it's a clear signal. Their interests are aligned with their wallets, not with your long-term success. You might be thinking, who has time for all this boring stuff? Reading footnotes and proxy statements sounds like a chore. And yes, it can be. But remember, this isn't about guesswork. It's about facts. Begin by downloading annual reports, Form 10-K, and quarterly reports, 10-Q, from the SEC's Edgar database. Don't be deterred by the dense legalistic language. That's often where the truth hides. Start from the back in the footnotes and work your way forward. Look for what companies capitalize, what they expense, what they call special items. Compare their past promises with actual outcomes. This deep dive is your most powerful defense. The bottom line, investing without thorough analysis is akin to navigating a minefield blindfolded. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework. You must supply the emotional discipline. By embracing diligent research into financial statements, understanding accounting practices, and scrutinizing management's actions for conflicts, you empower yourself to make truly intelligent decisions. If you want more actionable insights like these to build your intellectual framework, subscribe to Audiobook Bites so you don't miss our next deep dive into financial wisdom. 9. Shareholders and management. Today, we're diving deep into the core responsibility of being an intelligent investor, your role as a business owner. Benjamin Graham insists that a stock isn't just a ticker symbol or an electronic blip. It is an ownership interest in an actual business, with an underlying value that does not depend on its share price. This is not a passive role. As an owner, management works for you. So, how do you ensure your employees, the company's management, are working in your best interest? First, you must critically evaluate their efficiency. It's not enough for a company to simply make money. You need to compare its profitability, size, and competitive edge against its peers. Are they merely coasting? Or are they truly innovating and generating superior returns on capital? If the numbers falter, if they consistently underperform, then you, the owner, have every right to demand answers and, if necessary, advocate for change. But here's the catch. Most individual shareholders remain silent, even when the business they own is being mismanaged. Consider a company's dividend policy. In Graham's era, a liberal dividend payout was the norm. Management would often reinvest profits, but only after demonstrating that such retention genuinely benefited shareholders through increased earnings per share. However, in the late 1990s, a daddy-knows-best mentality swept through corporate America. Companies like Oracle and Microsoft hoarded billions in cash, claiming it was for future growth, but often it sat idle or was squandered on dubious acquisitions. Management promised that holding onto your cash was better for you than giving it back. But as Graham knew, the value of any investment is, and always must be, a function of its present price. The higher the price you pay, the lower your return will be. Therefore, you must demand transparency. If they retain earnings, they must clearly demonstrate superior reinvestment. If they cannot, that cash belongs in your pocket. But it gets worse. Executive compensation, particularly stock options. In companies like Enron, top executives were granted vast stock options that gave them immense personal profit, even as the company veered toward disaster. Remember Andrew Fastow, Enron's CFO, deeply involved in partnerships that bought assets from Enron, sometimes with money borrowed from Enron. His personal interests were diametrically opposed to shareholders. You might think such blatant conflicts are rare, but stock options often incentivize managers to pump up stock prices in the short term, not build sustainable long-term value. This dilutes existing shareholders' ownership and, perversely, stock buybacks, often funded by your cash, are then used to offset that very dilution, all while enriching insiders who cash out their options. This isn't about stratospheric IQ, it's about emotional discipline and diligence. You have the ultimate power, your vote. Read the proxy statements your company sends you. Understand compensation plans. Challenge policies that don't align management's long-term interests with yours. Because to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework. You must supply the emotional discipline. Asterisk asterisk. The bottom line, your wealth is not just built. It must be diligently protected from those who manage it. 10. Cultivating intelligent investing. Welcome back to Audiobook Bites, where we distill the timeless wisdom of investing. Today, we synthesize the enduring lessons from Benjamin Graham's classic, The Intelligent Investor, focusing on how to cultivate intelligent investing through self-control and clear mental models. Imagine Mr. Market, your eccentric business partner, knocking on your door every day. Some mornings, he's euphoric, eager to buy your shares at outrageous prices. Other days, he's deeply depressed, offering to sell you his stake in the same businesses for pennies on the dollar. Here's the catch. The intelligent investor treats Mr. Market not as a guru, but as a manic depressive servant. You don't have to follow his wild moods. You only do business with him when his irrationality offers an advantage. As Graham famously stated, the market is a pendulum that forever swings between unsustainable optimism, which makes stocks too expensive, and unjustified pessimism, which makes them too cheap. The intelligent investor is a realist who sells to optimists and buys from pessimists. This leads us directly to the second crucial mental model, the margin of safety. You might be thinking, but how can I possibly know if a price is truly advantageous? Graham's answer is profound in its simplicity. It's not about pinpoint prediction, which is a fool's errand. Instead, it's about buying a business for significantly less than its intrinsic value, a buffer that protects you against unforeseeable errors and market downturns. As Graham taught, no matter how careful you are, the one risk no investor can ever eliminate is the risk of being wrong. Only by insisting on what Graham called the margin of safety, never overpaying, no matter how exciting an investment seems to be, can you minimize your odds of error. This principle is your ultimate insurance policy. This concept naturally clarifies the rigorous distinction between investing and speculating. Many chase hot stocks, mistaking fleeting price jumps for true value. But to Graham, a stock is not just a ticker symbol or an electronic blip. It is an ownership interest in an actual business, with an underlying value that does not depend on its share price. Therefore, if you buy based on price momentum or market hype, without a thorough analysis of the underlying business and a built-in margin of safety, you are speculating, not investing. True wealth, Graham shows, is built through patient, disciplined ownership of sound businesses acquired at reasonable prices. Your greatest challenge in the financial world is often not the market itself, but your own emotions. Picture yourself in a future bear market, headlines screaming, your portfolio shrinking. Will you panic and sell, or will you see it as an opportunity? Graham's wisdom offers a clear path. The sillier the market's behavior, the greater the opportunity for the business-like investor. Follow Graham and you will profit from folly rather than participate in it. Mastering your emotions. Greed when prices soar, fear when they plummet, is paramount. This emotional discipline allows you to exploit Mr. Market's folly, rather than becoming a victim of it. The bottom line, to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This book precisely and clearly prescribes the proper framework. You must supply the emotional discipline. If you're ready to master your financial destiny and deepen your understanding of these critical principles, subscribe to Audiobook Bites so you don't miss future insights into how to apply timeless wisdom in today's dynamic markets.